So imagine you're trying to rebuild a commercial airplane's engine, right? But you're doing it while flying at 30,000 feet.
Right, yeah, that sounds terrifying.
Exactly. I mean, the engineering involved is brilliant, but the investors in this case are getting incredibly nervous about all the
Well,
turbulence.
yeah, and they have every right to be.
Right. So, welcome to today's deep dive. We are acting as your specialized equity analysts today, and we're constructing a really comprehensive investment thesis on Meta platforms, or Meta, for the remainder of 2026.
And we've got a massive stack of sources to go through to figure this out. I mean, we are pulling from Meta's newly released 2025 SEC 10K report, deep dive technical analysis from trading platforms, and some really heavy-hitting Wall Street notes from JP Morgan and Arete.
Plus the latest tech industry news, which has been pretty wild lately. Because the overarching mission here, the thing you really need to understand as a listener, is that Meta is undergoing this high-stakes evolution.
Yeah, they are completely pivoting.
They are. They are trying to go from a dominant social media conglomerate into this foundational personal superintelligence powerhouse.
Which is a huge leap.
It's massive. And our goal today is to cut through all the PR, all the noise of these recent market jitters, and determine the true risk versus reward for holding Meta in your portfolio right now.
Right, because if you're holding Meta, or even just watching the tech sector, you need to know if this transition is actually going to work.
Exactly. So before we look at where the company is going with all this superintelligence stuff, we have to talk about what the stock is doing right now, because the turbulence is real.
Oh, it's very real. The market is definitely spooked.
Yeah. Right now, Meta's stock is just hovering in this tight, volatile channel between $614 and $638. I mean, we've seen a 16% correction over the last 6 months.
Yeah.
And there was just a really brutal daily drop today of 2.5%. So what is driving that?
Well, the short answer is CapEx anxiety. The market is just suffering from acute capital expenditure anxiety.
Because the numbers are huge.
They're astronomical. I mean, Meta announced their CapEx for 2026 is going to skyrocket to somewhere between $115 billion and $135 billion.
Wow. Wait, so that's
That's an 88% jump from their 2025 spend.
an 88% jump in 1 year? For a mature trillion-dollar company, that's just insane.
Right. Institutional investors are getting complete vertigo looking at that guidance. They're essentially tearing up the floorboards to build out this new division, the Meta Superintelligence Labs, or MSL.
MSL, right.
And they recently brought in Alexander Wang, the founder of Scale AI, as their new chief AI officer to lead it. They've been poaching this super team of researchers to build these new flagship models, codenamed Mango and Avocado.
Okay, so they're spending heavily on talent and infrastructure to compete with OpenAI and Google. But this brings us to the recent news that drove that 2.5% drop today, the Maltbook acquisition.
Yeah, Moldbook. This is a fascinating move.
I mean, I have to push back on this one, because on the surface, it looks like just a massive unforced error.
It does look bad initially, yeah.
Right. Maltbook is this AI agent social networking platform, and it recently went viral for all the wrong reasons. The platform was completely flooded with fake AI-generated posts. It was a mess of bot hallucinations.
Yeah, absolute disaster zone.
Right. So why would Meta, a company that has already been under a global regulatory microscope for a decade regarding misinformation, why would they buy a platform famous for synthetic garbage?
Well, because they actually don't care about the posts at all. The synthetic garbage was basically just exhaust fumes.
Okay. So what did they actually buy it for?
They bought it for the underlying plumbing. Maltbook pioneered this novel technology that's basically an always-on directory.
An always-on directory. Explain how that works.
Think of it like the infrastructure layer. It's a system that allows thousands of disparate AI agents to autonomously discover each other, verify parameters, and collaborate 24/7.
Oh, I see.
Yeah, without any human intervention. So the reason Maltbook was flooded with quote-unquote fake posts was actually because these autonomous agents were just pinging each other, negotiating and talking in the open.
Wow. And the user interface just displayed that back-end communication as front-end social posts.
Exactly. So the industry right now, they've moved past the novelty of just building a smart, isolated chatbot. The real bottleneck is interoperability.
Right, getting them to talk.
Yeah. How do you get your personal AI assistant to autonomously negotiate with, say, a localized airline AI agent to rebook a canceled flight while you're asleep?
You need a directory.
You need an always-on directory. So Mango and Avocado, those are the brains. But Maltbook's architecture is the nervous system.
That makes total sense. But building that nervous system requires that $135 billion war chest. And to float that kind of capex without completely diluting shareholders, you need an absolutely flawless cash cow.
Which brings us to the advertising engine.
Right. Let's look at the 2025 financials from the 10K, because this is what's paying the bills. And the numbers are staggering.
Truly staggering.
2025 revenue hit $201 billion. That's up 22%. And it's driven by 3.58 billion daily active people.
Which is just, almost half the planet logging in every single day.
Yeah. And ad impressions globally grew 12%, with this massive 24% surge in the Asia-Pacific region. But here's the wild part. The average price per ad also increased by 9%.
Right, which defies basic economics.
It totally does. If you drastically increase the supply of ad inventory, the price per unit is supposed to drop. But Meta is increasing supply and hiking the price. How are they doing that?
Well, our sources highlight this concept called the Northwise Project framework. The argument here is that analysts need to stop looking at Meta as just a media company.
Okay, so what are they?
They're infrastructure for performance-driven commerce. AI tools like Advantage Plus are drastically improving ad conversions.
Right, Advantage Plus.
Yeah, an advertiser just feeds the system a budget and some creative assets, and the AI handles the rest. It finds the exact subset of users ready to buy. Because the conversion rate is so incredibly high, the return on ad spend justifies that 9% premium Meta is charging.
They've turned advertising from a speculative expense into basically a guaranteed margin generator for these brands.
Exactly. And the AI is doing something else too. It's acting as an internal cost suppression engine.
Meaning what? Automating their own jobs?
Pretty much. They're using AI for coding, for bulk content moderation, for managing data center thermal loads. So they are flattening their operating expense growth while massively scaling revenue.
Okay, but it's not all smooth sailing. Let's jump in with the caveats here, the headwinds.
Yeah, there are definitely headwinds.
First, there's Reels. Short-form video is growing like crazy, but it still monetizes at a way lower rate than the static feed or Instagram stories.
Right, the format just makes it harder to inject those direct response ads without ruining the user experience.
And then there is severe regulatory pressure, the EU's Digital Markets Act.
Oh, the DMA. This is a big one.
Yeah, the DMA is forcing Meta to roll out less personalized ads in Europe. And that threatens the exact predictive targeting precision that justifies their high ad prices in the first place.
Yeah, if you strip away the behavioral tracking, the algorithm loses its accuracy. And if accuracy drops, advertiser costs spike, and Meta loses the leverage to charge that premium.
Which creates a huge problem, right? The ad engine is humming right now, but the infrastructure required to fuel this whole AI arms race is getting wildly expensive.
It really is.
So how are they mitigating those costs? Let's talk about hardware and some pretty creative accounting.
Right, well, let's start with the hardware side. Meta is trying to shift away from total reliance on NVIDIA. NVIDIA basically holds a monopoly on the high-end GPUs needed for AI training, and they charge a massive premium.
So Meta is deploying custom in-house chips, the MTIA 400, 450, and 500 series.
Exactly. But they're also doing a multi-vendor strategy. They're simultaneously expanding compute deals with AMD and Google.
It's like realizing your daily Uber habit is just completely bankrupting you. So you start building your own car parts in the garage, while occasionally renting from Avis and Hertz just to hedge your bets.
That is actually a perfect analogy. It fragments their software stack, which is a total engineering headache, but it forces hardware vendors to compete on price.
Okay, but you still have to physically house all these chips, right? You have to power them. And this brings us to that creative financing piece from the JP Morgan note, the Hyperion Data Center in Louisiana.
This is a really fascinating piece of financial engineering. So instead of funding this massive data center from their own balance sheet, Meta partnered with an alternative asset manager called Blue Owl.
Okay.
Together, they created a special purpose vehicle, or an SPV. And that SPV took on $27 billion in investment-grade debt to build the facility.
Wait, $27 billion of debt, but S&P allows this to stay completely off Meta's balance sheet.
Yep.
Wow. So they get the data center, but technically they don't hold the debt on paper.
Exactly. But JP Morgan warns that this is a huge hidden risk. Because if you do consolidate that SPV debt to see the true economic reality, Meta's net debt to EBITDA jumps from being basically negative at the start of 2025 all the way up to 63%.
That is a massive swing. So the true debt is significantly higher.
Right. And there's a depreciation risk, too.
Right, the lifespan of the chips.
Meta is assuming their GPUs will last about 5.5 to 6 years. But the pace of AI advancement is so fast.
Yes, yeah.
JP Morgan says if those chips become obsolete in just 3 years instead of 6, the accelerated depreciation would wipe out over 3% of their operating margin.
3%.
Yeah, and it would drop their earnings per share by 7%.
That's brutal. So, okay, we've looked at the visionary tech, the AI agents, the ad engine, and now these hidden balance sheet risks. So for you listening, trying to manage your portfolio, what is the ultimate risk versus reward here? What is the real bull versus bear case for Meta in 2026?
Well, let's start with a snapshot of the valuation.
Okay.
The trailing PE ratio is sitting around 30x right now, but the forward PE is actually a very attractive 22 to 23x.
But the free cash flow yield has dropped, right? From 3.3% down to 2.6%.
It has. But the bull case is still really strong for a lot of analysts. Despite all this massive capex, Meta officially expects 2026 operating income to exceed 2025.
Because of that internal AI cost suppression we talked about.
Exactly. Plus, WhatsApp business is finally waking up. It's being monetized and has actually surpassed a $2 billion run rate.
Which is huge. They've been sitting on WhatsApp for years trying to figure out how to make money off it.
Right. So Wall Street consensus remains a strong buy. Average price targets are clustering around $832 to $864, with a high of $11,144. And by 2030, analysts project EPS could hit $45 to $56.
Okay, that's the upside. But let me counter with the bear case, because the downside is real. Free cash flow dropped 16% in 2025, down to $43.6 billion.
Yeah, it's a big hit.
And the Reality Labs division, the whole metaverse play, it lost over $21 billion, just burning cash.
Just setting money on fire, honestly.
Yeah. And analysts like Arete, they've actually downgraded the stock to neutral with a $676 target. They're warning that expenses are just rising faster than sales.
And Arete points out another structural disadvantage. Meta lacks the third-party cloud demand that Amazon or Google enjoys.
Oh, right. When AWS overbuilds, they can just rent the extra servers to other companies.
Exactly. Meta can't do that. They're building a $135 billion house, and they're the only ones living in it.
Okay, so if you're a listener who wants exposure to Meta's upside, because the AI tech is undeniable, but you're just totally spooked by this single stock capex volatility and the SPV debt, what are the alternatives?
Well, the sources highlight that Meta is a core Magnificent Seven stock. So if you're risk-averse, broad S&P 500 or NASDAQ composite ETFs serve as excellent diversified alternatives.
Right.
You'll still hold a large unavoidable position in Meta, but you cushion the blow if that Hyperion data center debt becomes a real problem.
That makes sense. Okay, so to wrap up this deep dive, it's pretty clear that Meta in 2026 is the ultimate high-conviction, high-volatility play.
It really is.
It's this real-time test of whether spending $135 billion on intelligence will yield trillions in infrastructure value, or if it's just going to trigger a 2022-style bubble crash.
Yeah, the stakes literally could not be higher.
And for you listening, whether you're adjusting your retirement portfolio or prepping for a big finance meeting or just trying to understand where the tech world is heading, Meta's financials offer probably the clearest window into the true economics of the AI era.
Definitely. But I want to leave you with a final kind of provocative puzzle to mull over, something that really struck me in the sources.
Oh, yeah. Let's hear it.
So Meta is giving away its Llama AI models for free to developers, right? Open source.
Right. Totally free.
But simultaneously, they are spending hundreds of billions on the physical infrastructure to run those models.
Yeah.
So if Meta successfully commoditizes artificial intelligence so that the software is cheap and everywhere, will their massive physical data centers become the most valuable toll booths of the future internet?
Oh, wow.
Or will those massive physical buildings just become multi-billion-dollar stranded assets?
That is the question, isn't it? Are they building toll booths or just, pouring concrete in the desert?
Exactly.
Well, thank you for joining us on this deep dive. As always, keep questioning the numbers, and we'll see you next time.